It just broke below the 199 level. The dollar is weakening, which means that global liquidity is loosening. Here is another critical signal. US inflation is dropping fast because when inflation falls this hard, the Fed no longer needs to keep rates high, specifically the crypto fear and greed index. Right now, we are sitting at 39, still in fear territory. Now, that might sound bearish, but for experienced traders, this is often where the best setups form. For a while, Bitcoin wasn't really going anywhere, but then, all of a sudden, the price shot up. Buyers are defending key levels. Accumulation is happening under resistance. It is calculated positioning. Bitcoin price at a crossroads. Let's go long. A bear market? No! Bitcoin's rally is just getting started. A lot of people are panicking right now, but I believe this is exactly where the real uptrend begins. You want to know why I'm saying this with such confidence? Because the data tells a completely different story, one that most people are missing. Let me show you. Let's start with the macro signals. The dollar is breaking down, inflation is dropping, and rate cuts are back on the table. That's not what a bear market looks like. That's the setup for a breakout. Let's go. We start with the dollar index, the DXY. It just broke below the 199 level, which is a big macro signal. Why? Because that level has been the support for almost 2 years. The last time DXY was this low was in mid-2022, right before we saw a massive wave of liquidity hitting markets. So, what does that tell us? The dollar is weakening, which means that global liquidity is loosening. When liquidity returns, risk assets rally, and Bitcoin is often the first mover, right? Investors feel more risk-prone. Historically, a falling dollar often correlates with rising Bitcoin prices, not because Bitcoin is magically tied to the dollar, but because the dollar is a proxy for risk appetites. Back in 2020 and 2021, this same setup played out. The dollar fell and Bitcoin rallied massively. This drop in DXY is not a random move, it comes at the same time as a falling macro fear. Trump tariffs headlines have gone quiet and volatility is drying up. That's the market signaling a return of risk appetite. So, macro backdrop, turning supportive. Here is another critical signal. US inflation is dropping fast. We are seeing the inflation index drop from above 3% down toward 1.6%. That's a massive cool-off in pricing pressure, and this changes a lot for the Fed, because when inflation falls this hard, the Fed no longer needs to keep rates high. Rate cuts become not just possible, but likely. And with political pressure mounting, the Fed has even more reason to cut. And when rates are cut, that's when liquidity floods in, and risk assets like Bitcoin tend to explode to the upside. Now, let's bring in one more piece of the puzzle, the US 10-year Treasury yield. Just a few weeks ago, this yield spiked above 4.6%, causing real fear in the markets. But look at what's happening now. Yields have pulled back and are stabilizing near 4.334%. And that's important. Why? Because when yields spike, it signals a fear of inflation or aggressive Fed policy. That drives money out of risk assets. But when yields cool down and stabilize, as they are doing right now, markets breathe, volatility drops, and confidence returns. Now, let's talk about market sentiment, specifically the crypto fear and greed index. Right now, we are sitting at 39, still in fear territory. Now, that might sound bearish, but for experienced traders, this is often where the best setups form. Think about it. Last week, the index was at 31, extreme fear. This week, it's ticking up, but still cautious. Meanwhile, the charts, macro trends, and positioning are all turning bullish. What this tells us is simple. The price is starting to move before sentiment catches up. Historically, major rallies often begin when the majority of the market is still afraid. That's exactly what we are seeing now, and it only strengthens the case for going long. Smart money enters when retail is hesitant, and that's the window we are in right now. Let us zoom out this long-term Bitcoin chart. Check it out, and you will see why this breakout might be just the beginning. In 2017, Bitcoin broke above a red top-line resistance, and then surged into the final leg of its bull markets. In 2021, the same thing happened. breakout first, top much later. Now, in 2025, we've just broken out again, and if the pattern holds, the top isn't in. It is still to come. So, this move above the top line? It's historically the beginning of the explosive phase, not the end. That aligns perfectly with everything we are seeing right now. Liquidity flowing in, inflation dropping, risk appetite rising, and Bitcoin technically called for continuation. So, how is this playing out on the heatmap? For a while, Bitcoin wasn't really going anywhere. It just kept moving slowly between 84k and 85k like it was working in place. But then, all of a sudden, the price shot up. It jumped super fast and reached 87k in just a short amount of time. Why did that happen? Well, there were a lot of traders who were betting that Bitcoin would go down. But when the price started going up instead, those traders got scared. They had to buy Bitcoin quickly to stop losing money, and that buying pushed the price up even more. That's what we call a short squeeze. Now, here's the interesting part. After that big jump, a bunch of people started buying again around 86k. It's like they were saying, oh, this ride isn't over, I want in. That 86k area became a strong support level where buyers are stepping in. So right now, the price is kind of resting near 87k, 88k. If people keep buying, it might go up again. But if it falls below the 86k, it could drop a bit lower before trying to bounce again. Now, let's talk about what Bitcoin itself is doing. We've got a solid 4-hour structure on Coinbase. Bitcoin bottomed near 79k, absorbed selling, and has since reclaimed 85k. It's sitting on top of a high volume node and just beneath a thin liquidity pocket up to 88k. The VPVR, volume profile, shows there is not much resistance between 85.5k and 88k. That's an area price can move through quickly. We call this a volume gap. In short, buyers are defending key levels. Accumulation is happening under resistance. Once we break that 85.5k level, there's room to run fast. Let's take a look at real-time order book behavior. On Coinbase and other major exchanges, we are seeing a gradual buildup of buy-side liquidity just below markets. No signs of retail FOMO, or fear of missing out, or over-leverage. This is calm, confident positioning, the kind that comes before a sustainable move. In other words, this isn't FOMO. It is calculated positioning. Add to that, whales and funds tend to accumulate in boring ranges, and that's exactly the behavior we have seen over the past few days. Small volume, low volatility, but steady support. So, what do you get when macro tailwinds meet a clean price setup and a patient market? A perfect storm for a breakout. So, if Bitcoin holds above 85.5k, that's the trigger zone. Once we break above 88k, I expect a rapid move toward 91k, 92k, where the next major liquidity pool sits. On the downside, key invalidation is if we lose 82k with volume, but for now, bulls are holding the line. Key levels to watch. Watch for a breakout above 85.5k, 86k. That's the gate to momentum. Next resistance is at 88k with potential extension toward 91k, 92k. On the downside, keep an eye on 82k, 83k, that's our support base. If we hold there, bulls stay in control. Bitcoin is standing on a razor's edge. But momentum is building fast. We are holding above 85k. Inflation is cooling, rates are stabilizing, and the dollar is weakening. That is not what a bear market looks like. This is a market preparing for a breakout. Sentiment remains in fear, but historically, that's exactly when the strongest rallies begin. Here are the key levels to watch. A breakout above 85.5k, 86k could open the door to 88k. And if that level clears, there is potential to accelerate toward 91, 92k. And even if we dip below 82k with volume, retail traders will likely panic and sell. But institutions, they will use that moment to load up even more. That's not a breakdown, that's silent preparation for the next leg up. I know this market has been tough. The volatility, the indecision, it shakes all of us. But in times like this, what we feel can be the most dangerous signal of all. What we need to trust is the data, the flow, the structure, the signals that we have led every major move before. And right now, those signals are lining up again. You will get through this, and I will be right there with you every step of the way. Thanks for tuning in. If this helped, don't forget to like, subscribe, and share. Stay sharp, stay calm, and I will see you in the next one.